Hey everyone, welcome to The Explainer. If you've ever looked at a company's financial reports and just wondered how on earth they can report massive, record-breaking profits but somehow still end up struggling to keep the lights on, well, you are in the exact right place. Today, we're demystifying how businesses report their true cash position by looking at the statement of cash flows. I like to think of it as the ultimate lie detector of financial reporting. We're going to explore how to analyze it, how to decode it, and even how to restructure it to reveal the actual operational reality that's so often hidden beneath standard accounting rules.
Okay, let's dive right into this. Here's our agenda for today. First up, we'll look at the linkages between the financial statements. Second, the direct method. Third, the indirect method. Fourth, converting that indirect method to the direct method. And finally, we'll wrap up by comparing US GAAP versus IFRS.
All right, let's kick things off with Section 1. Linking the financial statements, taking a macro view.
Now, before we can actually track the cash, we really have to step back and look at the whole scene of the crime. Think of the balance sheets on the left and the right as completely static. They're just snapshots of a company's financial position at a single point in time, right? Like December 31st of year 1 and December 31st of year 2. But as we all know, business isn't static. The flow statement's right there in the middle, your income statement, cash flow statement, and statement of equity. They bridge that gap, and this brilliantly illustrates exactly how we got from the beginning balance sheet to the ending one. The cash flow statement specifically zeroes in on one absolutely crucial asset from that balance sheet, and that's cash. So formally speaking, the statement of cash flows is a flow statement that reconciles the cash accounts between those two balance sheet dates. It does this by taking every single cash movement and sorting it into three distinct buckets: operating, investing, and financing activities. Now, this matters immensely because accrual accounting can very easily obscure actual cash movement. If you're evaluating a company's real liquidity and solvency, you absolutely have to look past the accruals and find the hard cash. Because here's the thing. Accrual accounting tells a story. It matches revenues and expenses to the periods they occur in, totally regardless of when the cash actually changes hands. But cash flow, that reveals the reality. Just imagine a hypothetical company that aggressively makes sales on credit to unqualified buyers. Under accrual accounting, their income statement is going to look amazing. They'd report healthy sales and incredible net income. But if those customers never actually pay their bills, the company has literally zero cash coming in. The cash flow statement is your absolute best tool for detecting these exact types of irregularities. It just strips away the entire narrative and leaves you with the undeniable facts.
Which brings us to Section 2, the direct method, or as I like to call it, following the cash.
So this brings up a huge question. When we want to know how a business is really doing day to day, how do we actually measure that operating cash flow? Well, accounting standards permit two different methodologies, and we're going to start with the most intuitive one.
The direct method is, well, exactly what it sounds like. It's a total focus on gross cash receipts and gross cash payments. It explicitly categorizes the money coming in, like the actual cash received from customers, and the money going out, like cash paid to your suppliers, to employees, or cash paid for interest and taxes. Analysts absolutely love this method because it provides a highly transparent, guessworks-free view of operations. There's no reverse engineering required. It's just money in from customers, money out to keep the lights out. Moving right along to Section 3, the indirect method, reconciling the differences.
Okay, so while the direct method is incredibly intuitive, the indirect method is the one you are actually going to encounter most often out in the real world. Now, what's really interesting about this slide is the core philosophical difference in direction. The direct method follows actual cash from the ground up, but the indirect method, it works completely backward. It starts at the very bottom of the income statement with net income, and then it makes a whole series of adjustments for non-cash items and working capital changes just to bridge the gap back to the actual cash figure.
Let's break down the mechanics of that indirect journey. You begin with your net income. The very first thing you do is add back your non-cash expenses. The classic example here is depreciation, right? Depreciation reduces net income on the income statement, but you didn't actually write a check for depreciation this year, so we add that cash right back. Next, you adjust for changes in working capital. Let's say your accounts receivable went up. That means you booked the revenue, but you haven't collected the actual cash from your customers yet, so you have to subtract that increase. Or if your inventory went up, well, you spent cash to buy that inventory, so you subtract that too. After going through all these adjustments, you finally arrive at your operating cash flow.
Let's jump into Section 4, converting indirect to direct. This is the analyst's hack.
All right, this is where we elevate things from basic theory to a true practitioner's skill. Since companies rarely give you the gift of a direct cash flow statement, you basically have to build an approximation yourself to reveal those hidden trends. It's a three-step process. First, disaggregate net income back into total revenues and total expenses. Second, strip out any non-operating and non-cash items, like that depreciation we just talked about. And third, adjust for changes in your working capital accounts.
Let's move to and see how this builds in practice for our fictional company, Acme Corporation. Looking at step 1 at the top, we take their net income of $2,210 and break it completely apart into total revenues and expenses. Then in step 2, we remove the non-cash noise. We take out a $205 non-cash gain from revenues, which gives us a clean revenue number of $23,598. We do the exact same thing for expenses, pulling out a massive depreciation charge. Finally, in step 3, we adjust for working capital. Acme's accounts receivable actually increased by $55, so we subtract that from our clean revenue to find that the actual cash received from customers was $23,543. And just like that, we've successfully hacked an indirect statement into a direct one.
Now, you might be sitting there wondering, why go through all this math? Why bother converting it at all? We do this to uncover the true trends in cash receipts and payments that indirect reporting so often hides. Cash received from customers is a significantly purer metric than some heavily adjusted net income figure. It tells you exactly how much money your core customer base is actually handing over to you, completely stripped of all accounting assumptions. Let's wrap things up with Section 5, U.S. GAAP versus IFRS, Navigating the Global Rules.
It is absolutely crucial to understand how differing international accounting standards can legally alter a company's cash flow narrative. In the U.S., GAAP rules are pretty rigid. Interest received, interest paid, and dividends received are all strictly classified as operating cash flows. But under international IFRS rules, there is massive flexibility. A company can choose to classify interest paid as an operating activity or a financing activity. They can classify dividends received as operating or investing. This flexibility is a huge differentiator when you're trying to compare global competitors. And the logic for this flexibility is baked right into the international accounting standards themselves. Paragraph 33 of IAS 7 explicitly states that these items may be classified as financing and investing cash flows because they are, quote, costs of obtaining financial resources or returns on investments. I mean, the official logic is perfectly sound, right? Paying interest really is a cost of financing your business, so why not put it in the financing section?
But here is what you really need to take away from this. Flexibility allows managers to paint a best-looking picture of their operating performance. Consider the fascinating case of Norse Energy. They were a Norwegian gas explorer. Back in 2007, operating under IFRS rules, they strategically switched their classification. They moved interest paid out of operating cash flows and into financing, then they moved interest received out of operating and into investing. And the net effect of this, a perfectly legal accounting shift that magically transformed their operating cash flows from a negative burn rate into a positive, sustainable-looking number, just by moving numbers to different buckets.
Which leaves us with a critical thought to close on today. When you sit down to analyze a company's cash flows, whether you're checking the indirect adjustments or navigating these tricky international classifications, ask yourself, are you looking at the true operational reality or just a perfectly legal accounting masterpiece? Always read the footnotes, always follow the actual cash, and never stop digging beneath the surface. Thanks so much for joining me on this explainer. Keep analyzing, and I'll see you next time.